Automakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards in for Francine Lacqua this morning here in London. Now, President Trump says reports he's seeking a summit with China's President Xi are not correct. In a post on Truth Social, President Trump said, "I may go to China, but it would only be at the invitation of Xi." The comments came as American and Chinese officials met in Stockholm to discuss trade. U.S. Commerce Secretary Howard Lutnick says President Trump will decide if Washington and Beijing will extend their trade truce by 90 days. Lutnick told Fox News more deals are likely with other countries in coming days.
The president's going to decide, look, this is how I want to play it. He may entertain a few more deals, or he may decide, you know what, I'm just going to set the policy going forward. But by the end of this week, they will all be set, they will all be in stone, and they will be written, and we will start collecting those additional monies. Right now, we're collecting 10% from everybody in the world, and of course, a higher rate from China. But come next week, off we go.
So there are a lot of trade angles in the mix today. There's the US-China conversation, the Europe-US conversation. There's all the deals that have yet to be done. Maybe they will be done. We'll cover all of these with our correspondents in a moment. We'll talk to Lizzie Burden about the EU's trade deal and President Trump's visit to Scotland. But first to Stockholm, where Bloomberg's Oliver Crook is tracking the talks between the US and China. And we understand that the Treasury Secretary has just arrived for those conversations in Stockholm, then getting quite a lot of air miles involved in these trade conversations then, Ollie. What can we expect from these talks?
Yeah, so Anna, we have right now the Prime Minister's office of Sweden there that's hosting these talks between the Chinese and the United States. You have the American flag, the Chinese flag, and the Swedish flag flying out this morning. And we've just had the U.S. Treasury Secretary walk through the doors. He was also flanked by Jameson Greer, the U.S. Trade Representative. And this is the second day of the talks between the Chinese and the United States. The expectation here, Anna, is that we're not going to get any sort of final framework or anything comprehensive like we got from the European Union between the United States. But we will get, hopefully, an extension of the truce in the trade war that had been going on between China and the United States, where we saw tariffs shoot up to 125%. They came back down to 30%. And the deadline for those is August the 12th. What they are hoping to achieve in that room today is another extension of 90 days to continue the negotiations between China and the United States to get eventually on the footing where you could have potentially a comprehensive trade deal between the two biggest economies in the world.
And President Trump has been saying that he's not seeking a summit with China's President Xi, Ollie. It seems he doesn't like the way that this potential meeting has been cast by many media outlets. He's not saying he's not going to talk to President Xi. He's not saying he won't go to China, but there was something about the wording he didn't like.
So I think that this speaks at the heart of the difficulty that you have between China and the United States, where we have seen the Europeans, the Japanese, and many other nations, whether it's the UK, there is a willingness by these countries in a sort of effort of pragmatism to get things done, to sort of genuflect and sort of theatrically give things to the United States. That is something that the Chinese have been categorically unwilling to do. That is why we saw that trade war really escalate up to 125% tariffs between the two sides, which basically precluded trade between the two blocs. For the Chinese, who have been spending the last several decades building up their economy, building up their status on the global stage, to bow to the Trump administration in a sort of theatrical fashion, even if some of these pledges of hundreds of billions of dollars don't ever materialize, is just not something they're going to do. From the Trump side of things, he has made it his pledge to basically right the wrongs of the Chinese sort of trading system across the world. That is something that he campaigned on. So he himself will also be making that clear. This is why, Anna, we are seeing with all of these air miles, these conversations happening in neutral places, whether it's the United Kingdom, whether it's Switzerland, whether it's Stockholm, because both the Chinese and the United States want to be seen as coming to these talks as relatively as equals. And that is going to be the difficulty that the Trump administration has in cracking this nut, while other sort of allies of the United States have been more willing to give, at least in the sort of theatrical and kind of in a sort of maybe superficial way. The Chinese are categorically unwilling to do that.
Oliver, thank you. Oliver Cook joining us there from Stockholm with the latest on China-US trade. There are plenty of other trade angles and conversations with the Trump administration taking place, and a lot of that conversation happening in Aberdeen in Scotland, because that's where President Trump is now. Let's go to Lizzie Burden, who has followed him from one golf course to another. Let's stick on the subject of trade, because that theme has followed him wherever he goes, Lizzie. The trade deal struck between the European Union and the US is facing some criticism from within Europe, and even the Germans, who were initially quite pragmatic about the outcome here, are now referencing some of the uncertainty created.
Yeah, I would just add to Ollie's point and say that part of the reason that the UK hosted those US-China talks and this weekend hosted those US-EU talks is because it is so crucial to the UK economy that they all go well. We're stuck in the crosshairs here. But when you look at the US-EU deal, you saw that market reaction yesterday. The euro tumbling against the dollar, its worst day in over 2 months, and the misery continuing today. You've heard from various EU industry leaders wishing that Ursula von der Leyen, the European Commission President, had been tougher. But there was this fear from the Commission that if they annoyed Donald Trump, that it could spill into other areas of policy as well. And the European Union, of course, very much divided on how to respond. France wanting to use that anti-coercion instrument, others not so keen on the ACI. Some officials, in hindsight, saying that they'd have liked Brussels to respond more like Canada and China in the aftermath of Liberation Day. Others wanting to play it more softly. We await details on that deal. But if you look at how Keir Starmer, the UK Prime Minister, has handled President Trump, that softly approach that we saw yesterday in Turnberry, it has been widely mocked, it has to be said. But look what it has achieved. Starmer was the front of the queue to get a trade deal of 10% compared to Brussels' 15%. And if he can negotiate 0% tariffs when it comes to steel, that would be a huge advantage for the UK compared to the rest of the world, including the EU. And then he wants this carve-out on pharma levies. So we'll wait to see what Starmer can achieve. Many details, as you say, Anna, yet to be ironed out.
Yes, and President Trump did meet with the UK Prime Minister Keir Starmer on Monday. So just yesterday, Lizzie, what were the conclusions from that meeting?
Well, aside from trade, Anna, there was a focus on Gaza and a win for Keir Starmer, perhaps, in that President Trump acknowledged, and he used the word, that there is starvation happening in Gaza. Keir Starmer is going to host an emergency cabinet meeting on this, on what to do next, later today in the afternoon. There was also a win for Starmer when it came to Ukraine, and the president really turning the screws when it comes to Putin. No more is the deadline 50 days for peace. It's 10 to 12 days for a peace plan. So we're waiting for more news on that front as well today, Anna.
Lizzie, thank you very much. Lizzie Burden from Scotland with the latest on President Trump's what was supposed to be a sort of private visit, but has turned into a host of meetings and encounters with the global media, as you would expect. Let's talk about where we are on markets. How do markets put all of this trade news flow together? We're joined now by Ursula Marchioni, who's EMEA Head of Investments and Portfolio Solutions at BlackRock. Ursula, very nice to have you with us.
Good morning.
So where do we look in markets for an accurate response to the trade deal between the US and Europe, or is it too soon to find one? I'm asking this because we've had 2 days of negativity on the euro. Yesterday, European stocks went down. Today, they bounced some way back to where they started. So is there a way in markets to get a sense of how good or bad this deal is for Europe?
Yeah, it's a very good question. So obviously it is early days, to your point, but I agree that this is a key question before we wrap for a couple of weeks of summertime and prepare for deployment and investments coming back into September. And I say that because taking a step back, this year has been a huge theme for global investors has been around repatriation. And so we've seen a lot of European equities purchases from European investors, a lot of APAC domicile investors going back into their markets. And so to your point, what's coming through now it's extremely important to see the longevity of that trade as we return. So I would say, taking a step back and wrapping up on trade, it seems to me that a soft landing scenario somehow is emerging. We have a deal with the UK, obviously last week Japan, and now entering into this week the big mighty one with the EU. And it's certainly a significantly worse position vis-à-vis where we were at the end of last year, but it is a better position vis-à-vis where we could have been as per Liberation Day. Yeah. And so taking a step back, I think at least there's an element of certainty that investors can take into the summer as they reflect into September. There's two more elements, and I think that need to be coupled with that, though. One is the earnings season that is unfolding, and then the other one is obviously the tourbillon of data that is coming out this week. So I think these three components will be crucial as we think about investment directions.
Yes. So as we regroup for the rest of the year then, Ursula, I mean, what do we take from the earnings season so far? It seems as if some corporates came in with very conservative expectations about what tariffs would do to the business, and then there's even some upside from there now. Others came in with less conservative expectations, and now there's some downside given what we know about tariffs. So what are you taking away on the tariff conversation from the earnings story?
Definitely. And yeah, there's a lot of, last 24 hours from FX perspective, looking at luxury, there's like so much coming through. But again, trying to take a step back, if I look at the US, we've seen about 35% firms reporting, 60% of them have reported a beat in EPS growth vis-à-vis a bar, which was allegedly quite low, 4%, but there's good news coming there. And similarly in Europe, we had a very low bar at 2% in terms of earning year-on-year growth, and we're tracking at 8%, although we're 1/3 in. Big week this week, 37% of the S&P 500 reporting, with 4 of the Max 7. But I think broadly speaking, it's been a benign environment, which tells us that throughout Q2, the tariff pass-through hasn't quite played out. And so I think, to your point, we now have more clarity on tariffs. My key question is, would we see a scenario whereby, at the back of greater clarity, corporates start to pass on more of this to the consumers? It's a clearer picture, and you could argue that that would be a potential scenario that unfolds. And in that case, and that's where I come to the third leg of this triangle, what happens to data? Because we're going to start to see inflation passing through. This week will be super important in terms of, inflation data, non-farm payrolls on Friday, Q2 Eurozone and US GDP. Again, unlikely to see the full transmit of the tariffs because they were still in the making. And so I think that it will be interesting to see early signs of that, but those three components will be the key foundation.
Does it feel as if we're going to have to wait a lot longer than we perhaps initially thought, Ursula, for that pass-through of tariffs to show up, either in corporate margins or in inflation data, depending on who's going to be paying for this? Because it's not coming through very quickly. That seems to be the case.
That's fair, but I wouldn't bet on that. So I think that, fine, this week will be an important piece of the jigsaw puzzle, but I think that clarity that we now have on the scenario for a lot of the trade deals, and yes, of course, China, Canada are still in motion, but we have quite a lot in the bag now, might trigger a transmit mechanism there. And so again, as I think about coming back from the summer, there's two big areas that are top of my list. One is diversification, and the second one is what happens to that repatriation trade. So maybe I'll start with this. European investors have bought into European equities with vigor. We've seen 5 times the flows into European equities from European investors that we saw last year at this point in time. And a lot of the trade is funded out of US. I think you've seen a lot of diversification elements coming through in terms of emerging markets, both in fixed income and in equities, where we're seeing strong buying, and certainly dollar weakness is a catalyst. But I think there's a broader theme at portfolio level in terms of trying to diversify away from the US. So the key question is, going into September, what happens to that? My sense, speaking with a lot of clients, is that appetite continues, but it will be important to be differentiated. One thing that caught my eye is, if you look at European equities and decouple two baskets of names, domestically focused and internationally focused, year to date, there's a 20% performance differential. And that tells you how important selectivity will be. Okay. And so for Europe, Still an area to watch, but again, selectivity either through active strategies or through sector plays. We saw industrials being beaten up over the last 24 hours, but taking a step back, that is a sector that tends to be more domestically focused and so can be more insulated going forward. Similarly for financials and banks.
Okay, so that's the European and the appetite from international investors for European assets. Let me ask you about CapEx, because when there's so much uncertainty around headlines around tariffs, you wonder whether corporates are going to feel confident enough to enact their capital expenditure plans. And this matters for those businesses, but it also matters for the AI trend. And I wonder what we're seeing there about whether businesses do have that confidence to spend, and if they're spending, is it all on data centers and AI?
I agree. I think this has been a core point in terms also of forward guidance with respect to CapEx and how that plays out. And it does closely connect with the US trade. We remain positive on the US because, again, that AI industrial transformation for us continues to play out. But again, moving into September, and I think one key element that I'm hearing investors continuing to be super focused on is what we do with FX. And so historically, a equity benchmark for the portfolio sleeve, for the equity sleeve of the portfolio, MSCI World with 73% exposure to the US wouldn't have been hedged back. And yet, if you look at a German investor year to date, their experience will have been over 20% in euro terms in the DAX and minus 3% in euro terms in the US. And so that differential, again, is extremely large at portfolio level. What to do going forward? I think US continues to be, including because to your point of the AI trade continuing to unfold, and we'll see this week more information coming, but continues to be a big transformative force. Yet the attention that we are seeing towards FX hedging, share classes in funds, to me, is definitely going to be a theme that we're going to carry through September.
Okay. Ursula, thank you very much. Thanks for joining us. Ursula Marchioni, EMEA head of investment and portfolio solutions at BlackRock. Coming up on the programme, Stellantis warns it will see a €1.2 billion hit from tariffs as it reinstates financial guidance. We'll bring you details next. This is Bloomberg. Welcome back. This is The Pulse, live from London. Stellantis expects to take a hit of around €1.2 billion from tariffs in the second half of this year. The maker of Jeep sports utility vehicles and Fiat cars has restated financial guidance following the European Union's trade deal with the United States. Let's bring in Patrick Hummel, who's head of European Autos Research at UBS. Patrick, thanks so much for joining us. So let's start with Stellantis, and then we'll look ahead to some of the other corporates that are reporting this week. The timing leads you to think that this is all about the EU-US trade deal, but actually is this more about Mexico? What's your takeaway from the Stellantis guidance that we've had reintroduced today?
Thanks for having me, Anna. Look, I think it's a quite disappointing guidance overall for the second half, especially on the cash flow side. That's the number one topic that our clients are picking up this morning. They're not ruling out a cash burn in the second half either after burning $3 billion of cash in the first half. And the balance sheet, I wouldn't say it's a red flag at this point, but it's surely not in the comfort zone either. So this is a key area of focus.
That's a key area of focus. And what is it that really matters to a business like Stellantis, Patrick, when it comes to these trade conversations? Is this very much about Mexico and the relationship between the United States and Mexico?
Yeah, I think for Stellantis, the USMCA framework is way more important than the deal between the EU and the US. So in that sense, we wouldn't be surprised to see the Detroit 3 trying to renegotiate a little bit on the USMCA tariff framework, because, you know, after the EU and Japan got a better deal, there is also some pressure now on the Detroit 3 again. Needless to say that Stellantis is in a very specific turnaround situation after losing a lot of market share in the US. The market share dropped over the last couple of years from 11 to 7%, and the new products that are now being launched have to resonate well with consumers at the right price points, and only then they can successfully master the turnaround and stop the cash burn.
And talk to me about broadly what the deal between the US and Europe means for automakers then, Patrick, because from your research, it seems that, they all have very different geographies, which will mean a different reaction to this news flow. And some of them had made very conservative assumptions ahead of this. Others had made less conservative assumptions. So it could mean very different things for different auto companies, it seems.
Yeah, that's true. I mean, of course, for the German OEMs, the EU-US deal was the most important one. And the burden versus a pre-tariff world has now shrunk. We calculate on a fully annualized basis between 10 and 15% impact on group operating profit for the German OEMs. That remains. That's a sticky part. It's clearly less disruptive than a 27.5% tariff. It's manageable, but nonetheless, it's a burden. And therefore, some OEMs will have to revise guidance downwards. We think Porsche and Mercedes will have to revise their guide downwards by 100, 200 basis points on the margin level. As a reminder, their guide, the old guide, is still on a pre-tariff basis, so that needs to be adjusted for. On the positive end, we think BMW on Thursday can just reiterate the guidance corridor because they had a better than expected second half. That's already based on the information that they disclosed. And with that, I think we see them well on track to meet the 5 to 7% margin corridor for the full year.
OK, so taking them in turn, so Mercedes, you say they look as if they're going to have to revise down their guidance, Patrick. That's your view, and we're waiting for numbers from them tomorrow. What else are we going to be watching for? What's the detail that matters around Mercedes?
Well, for Mercedes, they already disclosed some information in their pre-close call that was wide open to sell and buy side. So this has been well digested, but it was a second quarter at the very low end of expectations, even on a pre-tariff basis. And we need to understand what drove that. Also, the divergence to BMW, which had a much better second quarter, was remarkable. So this is the color we hope to get tomorrow. And then, of course, an updated guide, including the margins and the free cash flow. We think cash flow is a key item for Mercedes because they committed to return 100% of their free cash flow to shareholders in the form of dividends and share buyback. So we would expect a new free cash flow guide, to still be at least around 5 billion euros, which gives you a 10% cash return, dividend and share buyback combined.
Yeah, Patrick, for these German car companies, how much are we seeing? Is this a very niche story, or is it widespread that German car companies can or might find they want to increasingly make cars in the United States and send them to Europe based on the mismatch of the tariffs that now exist across the Atlantic? Is that something that they're doing at scale, or is this always just going to be small?
Well, it's certainly not a theme for additional investment at this point. Things might change, right? But it's certainly an asset for BMW and Mercedes to have large manufacturing hubs in the US. Both companies export their large SUVs from the US also back to Europe. And now the tariff has gone down from 10% to 2.5%. So this is clearly a tailwind, which, by the way, I had not included when I talked about the 10 to 15% operating profit impact of the new EU-US tariff deal. That other side of the trade is another few $100 million of upside to the EBIT of BMW and Mercedes.
OK, so an extra positive there. And just briefly, we get numbers from Renault and Pirelli as well, Patrick. What else are you watching for this week?
Well, Renault has a little bit the fallen star status now. After a few years of great execution under the old management team, there has been a profit warning a couple of weeks back. So we need to better understand, what the drivers behind that were. Also, of course,
we will look for that.
Absolutely, and people need to get to know the new management.
Thank you very much. I'm sorry to interrupt. We're just up against a break. Patrick Hummel joining us there from UBS. This is Bloomberg. Good morning and welcome to The Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning. Here are your top stories. The euro slumps and tariff optimism fades as critics speak out against the US-EU trade deal amidst uncertainty on some of the details. Trade talks between the world's two biggest economies roll into their second day in Stockholm. The US Commerce Secretary says a 90-day extension of the trade truce with China is a likely outcome. Plus, traders boost earnings at Barclays, while Stellantis warns of a €1.2 billion tariff hit in the second half of the year. Welcome back to the programme. Now, President Trump says he will shorten his timeline for Russian leader Vladimir Putin to reach a truce with Ukraine or face potential economic penalties.
I'm going to make a new deadline of about 10 or 12 days from today. There's no reason in waiting. There's no reason in waiting. It's 50 days. I want to be generous, but we just don't see any progress being made.
Joining us now, Bloomberg's Russia government and economy editor Greg Sullivan. Greg, so why has President Trump then shortened this deadline? I remember when we first got news of the longer deadline, markets responded with, well, oil. We certainly saw oil prices react, giving us the message that this was a very long time that was being given here. So why the shorter duration now?
That's right. Just 2 weeks ago, we heard President Trump give Vladimir Putin a 50-day deadline, and now he's shortening it. It's clear that Trump has been expressing more frustration with Putin over the pace of the negotiations. As his push for a ceasefire has largely met with intransigence from the Kremlin. Moscow has responded with mostly just maximalist demands that Ukraine will not accept. We've also seen an uptick in missile and drone barrages against Kyiv and other Ukrainian cities. Those are growing increasingly deadly, and all are fueling President Trump's frustration. It's worth noting that so far the Kremlin has been silent on this latest threat from Trump, and many analysts don't expect Trump's latest position to actually change President Putin's approach to the ceasefire.
Yes, and what is President Trump threatening then against Russia if there is no ceasefire in Ukraine within this new deadline then of 12 days, Greg? There's been a lot of talk in the United States about some kind of secondary tariffs on Russian energy products, for example.
That's right. So a few things from President Trump. One are these so-called secondary sanctions. He said that he would put secondary sanctions on countries that are buying Russian products. That's probably mostly energy products like gas and oil, which is why we've seen a response in the crude price. There's some worry out there that this could disrupt crude flows. Russia's a massive oil producer. So that is the most serious threat. But a lot of people don't actually expect Trump to follow through. There are serious questions here. Is President Trump willing to impose sanctions on China and India amid complex trade negotiations? Is he willing to disrupt the flow of crude? What mechanism could he use to impose these sanctions? So many questions still remain. It's also worth noting that in the past, Trump has threatened economic penalties against Russia and has not followed through, opting for room for negotiations. But there was a change of tone on Monday from President Trump as he said he's no longer that interested in talking to President Putin.
Greg, thank you very much. Bloomberg's Greg Sullivan on the relationship there between the United States and Russia. Now, moving on to other news flow this morning. A gunman has killed at least 4 people and himself in a shooting in New York City. It happened at a tower in Manhattan, which houses the global headquarters of Blackstone. Bloomberg's Shaquille Amari was at the scene.
This all unfolded around 6 Monday evening, where I saw a lot of police officers running in different directions, helicopters swarming the area for at least 3 hours. Now on the ground, fire and EMS crews flooded the scene with a lot of bystanders asking a lot of questions. Now there were police in tactical gear entering the building, and there were employees exiting the building with their hands above their heads in shock. Employees who were on the 32nd floor of the building say they pushed furniture in front of the doors to barricade themselves from the attack. Now, Blackstone is one of the largest asset management companies and employed almost 5,000 people at the end of 2024. Now, this is an ongoing investigation with so many questions remain as to what led up to this shooting. For now, in Midtown Manhattan, Shaquille Omari, Bloomberg News.
Now, the New York Mayor Eric Adams has described the shooting as senseless and unimaginable.
The horrific crime reminds us all how easy it is to gain access to a gun. Gun violence has scarred so many neighbors and ripped apart too many families across this entire country. And we will continue the fight to do all we can to protect our city.
On to corporate news flow, and the oil giant Vitol delivered a record $10.6 billion to its executives and senior staff last year through share buybacks, the biggest payout in the industry's history. The energy trader's 2024 profit hit $8.7 billion, which is more than its 4 biggest rivals combined. Vitol has now paid over $31 billion to its partners in the past decade, even as profits begin to cool. In other news, new data suggests India has overtaken China to become the top source of smartphones sold in the United States. According to Canalys, in the quarter to June, India accounted for 44% of the market. Vietnam, home to much of Samsung's production, came in second. China fell from more than 60% of all estimated shipments a year ago to just 25%. Let's stick with the emerging market theme. The global trade war that President Trump unleashed in April shook investor confidence in the United States, in the U.S. economy, so much that it sparked a stampede out of the dollar. Today's Bloomberg Big Take examines how much of that money has washed up in emerging markets. You can find that story on the terminal and Bloomberg.com. For a deep dive into the topic, I'm joined now by Vivian Thurston, Portfolio Manager at William Blair Investment Management. Vivian, nice to speak to you. So good to have a chance to talk about emerging markets then in the context of the trade narrative, what we've seen in the dollar. And maybe let's start with the big picture dollar impact. So real dollar weakness as a result of some of President Trump's trade policies. What has that meant overall for emerging markets?
Yeah. Historically, there's an almost perfect inverse correlation between the dollar's strength versus the emerging markets' local currency returns and also dollar-denominated return. So that means that weakened dollar tend to support the emerging markets equity in a very favorable way. This both due to the translation effect and also transactional effect. So when you have weak dollars tend to mean the local currency becomes stronger, that tend to lead to lower inflation, and that gave also the central banks of those countries the ability to lower their interest rate, and that helped both households and also corporate spending.
Okay, so there's the translation and the transaction effect that you described there, Vivian. And has that happened in this case? And if so, which are the emerging markets that have really been able to benefit?
Yeah, so far we've seen that Latin America, for example, whether Brazil and Mexico, we see their local currency really appreciates quite substantially. Broadly speaking, I would say that Asian equities also tend to do better, given that a lot of those countries rely on exports, and also domestic economy can be impacted by how the currency movement happen in their country. Yeah, so we tend to look at more domestic-driven kind of idiosyncratic opportunities from bottom-up perspective, given that uncertainty of the trade continue to weigh on the sentiment and the volatility of the market.
Yes, and we can't talk about emerging markets without talking about China. Things look very different if you include or exclude an economy the size of China. So what is your view on China right now? It seems earlier on in the year we were talking about some of the tariff impact, maybe providing more of a catalyst for the government and other actors to try and do something for the Chinese economy. What's your thinking?
Yeah. I think China facing both internal and external pressure from the economic perspective. Externally, we know the trade discussion definitely continue to put more uncertainty and complexity of how they're going to continue to work on the export side. But internally, China has been grappling with this deflation pressure for a few years already. That's even right before the COVID reopening. China continued to see this pressure of the property market reduce to consumer confidence. So you can see that PPI or PMI continue to be this weak territory for more than 3 years. So I think that is a key issue that I think Chinese government need to figure out how they can regentrify consumer confidence and the SMEs or small economies and enterprises' ability to reinvest. Having said that, we do see some industry within China start to show very strong improvement in terms of corporate fundamentals. So whether it's online gaming, some e-commerce players, or some new consumption themes, the self-indulgent kind of a consumption themes very popular among the Gen Zs in China.
Okay, and is that enough? Is it, sort of self-indulgent spending by Gen Zs, is that enough, Vivian, to boost the Chinese economy?
I think it's not enough. Yeah, because not very broad-based. But from investment opportunity perspective, it does provide the attractive underlying investment opportunities. But you're absolutely right. In order for the broader economy and consumer to really see that recovery and rebound, we do need to see the stabilization of the property market and the consumer confidence and the youth employment. So overall, I do think Chinese government need to figure out the fiscal support more effectively to stimulate the private sectors and also the consumer confidence.
Yes, and so whilst they're doing all of that, how crucial is it that we continue to see this truce between China and the United States on trade then for your China narrative?
Yeah, I would say the U.S.-China relations is entering this strategic competitors face, and that's been going on for a few years already. And this is structural. This is not going to change. So whether it's a trade conversation, whether it's some national security-led sanction or restriction kind of conversation, I think we will see this coming through from time to time. And that's why the risk premium on Chinese equities has structurally risen. But for trade conversation, as long as we come to the final kind of deal, I think it will be great for the market. Because the uncertainty is the worst for stock market. When you come to the final conclusion, the market can deal with it, the industry can manage it over time. So I think I'm hopeful that in the next couple of weeks or even a couple of months, we can see the final conclusion of the U.S.-China trade conversation.
How enthusiastic has U.S. money or global money been to head towards China at this point? I mean, we talked about how money was coming out of the dollar and investors were increasingly questioning whether they wanted to be all in on the United States, looking for global opportunities.
Right.
Has that included China? Have we seen that in flows?
Yeah, I do think especially Hong Kong listed companies in the Chinese company has seen a lot of inflows year to date, reflecting a very strong performance of MSCI China, which is primarily Hong Kong listed. And that's also coincide with a very strong IPO pipeline, including those new consumption themes and also some biotech kind of themes in China. So we do think this trend may continue as long as dollar weakness remains and also U.S. trade policy remain uncertain. So it's a good news for emerging markets overall and good news for Chinese equities.
Yes, and investing in Chinese tech, is that as much of an exciting theme as it was at the beginning of the year?
I do think you need to see the corporate fundamentals to continue come through in order for that sector to be favored by investors. And you're right that a lot of stocks in that space has rallied quite a bit, so not as cheap as before. So we need the earnings to come through.
Yeah, and in terms of other emerging markets then, Vivian, which do you think we've talked a lot about China. Where is there a very interesting story that doesn't get talked about so much in the media?
The other very important thing of emerging markets investing is AI semiconductor supply chain. And that means the Taiwan semiconductor or Korean semiconductor companies. So as you know, that the AI spending on the global level continue to accelerate by the hyperscalers and all the major players. That actually means the demand for all the supplies throughout the entire semiconductor and hardware supply chain will remain very robust. So that's why we see the opportunity among the Taiwan tech and some of the Korean tech. So that's one, I think, very interesting investment theme in the near term. The other one I want to talk about is Korea. Korea has this value up initiatives, and that could be also very interesting, given that this country has been in a very challenging corporate governance kind of state for some period of time. And as they start to put more effort about increase the corporate shareholders' return and the margins and returns, and we will see that equity continue to re-rate and with a better and improved earnings outlook.
Vivian, thank you very much. Thank you for coming in today to talk to us. Vivian Lynn Thurston, portfolio manager at William Blair Investment Management. To the UK now, the rising price of products such as tea and meat pushed food inflation to its highest level in 17 months. The British Retail Consortium said food bills climbed 4% in July compared with a year earlier, the fastest increase since February 2024. The data confirmed that a period of falling prices in shops has come to an end, in part due to the government's hike in the minimum wage and its efforts to raise revenue through higher payroll taxes. Shareholders in Wise have approved a proposal to shift its primary listing out of London, a move that will also allow the fintech's chief executive to keep his so-called golden shares for many more years. Wise has argued that moving its listing to the US will ultimately open up its shares to legions of retail and institutional investors, giving it more liquidity and presumably boosting its valuation. Coming up on the programme, sticking with the UK, Barclays plans to buy back £1 billion worth of shares after its traders turn in a better-than-expected quarter. More from our exclusive interview with the CEO. That's next. This is Bloomberg. Welcome back. This is The Pulse. Now, Philips increased its profitability outlook as the impact of the trade war was not as severe as the company had initially feared. The Dutch medical technology firm now expects its full-year adjusted operating earnings margin to be between 11.3 and 11.8%. Philips is asking for tariff exemptions for the healthcare sector. CEO Roy Jacobs telling Bloomberg that the company is expanding its presence in the US. EssilorLuxottica has posted better than expected revenue in the second quarter, showing strong gains in Europe as it pressed ahead with its smart glasses initiative. Revenue at the world's biggest eyewear maker increased 7.3% at constant exchange rates, ahead of the 5.9% expected on average by analysts. Sales of Ray-Ban Meta smart glasses more than tripled in the first half. And on to banking. Barclays is buying back a further £1 billion worth of shares after its traders turned in a better-than-expected quarter. The British lender's CEO, CS Venkatakrishnan, spoke exclusively to Bloomberg about the outlook for the UK economy.
I think the macroeconomic circumstances in the UK are poised to get better. There is a affinity to the financial sector now that's being expressed, the realization of our importance for the economy, and an impetus towards better, more sensible regulation overall. I think that will help banks. I think it will help international banks like us. And I think we've had macroeconomic stability in interest rates, in employment, and growth, while it is slow, is still reasonable. I think in the UK it's around 1%, and we hope it can be higher. But all the circumstances are coalescing. There's a constellation of ideas and energy and activity which will help spur growth.
Venkat, or CS Venkatakrishnan, also gave the bank's outlook for M&A, saying there will be more opportunity as the economy settles.
Broadly, M&A will increase as there is more stability in the macro environment. Of course, each company, each bank, each situation is very different. But I think there are rewards to scale. I think those rewards to scale will be realized. We are happy to have many, many businesses at scale, and we know how important it is to protect and to grow that scale. And new technology will only facilitate that and, in fact, increase the returns to scale. So I think that's what companies will be looking at.
Barclays CEO there, speaking to Bloomberg Television a little bit earlier on today. Now, joining us to talk about the banking sector, Anke Reingen, co-head of Global Financials Research at RBC Capital Markets. Anke, thank you for joining us. So we'll take a broad view of the banking sector, and one of the big themes came out in the Barclays earnings, but seemed to be evident in the earnings of other businesses as well, and that was that volatility can be a good thing when you're trading in these markets. And both in the first quarter and certainly in the second quarter, we've seen that from European banks, haven't we?
Yeah, I mean, everyone reported so far, US, European bank, you could see really the market's performance was really quite strong, benefiting from volatility. And I guess that's especially at the start of the quarter, across equities as well as fixed income, and it ebbed down towards the end of the quarter. And then you could see some of the origination and advisory fees picking up, which have been relatively weak in the second quarter, with some green spots. So I think what we now need to see across the overall business mix, markets has been the highlight. But I think what we need to see now going into second half of the year, will the investment banking fees pick up? And what level of volatility are we going to continue to see? Because if we look at the business mix of the investment banks, the trading is or markets, I should probably say, rather than trading, is a larger part than investment banking fees. So we need a decent level of volatility to sustain that market's momentum, as well as the volatility to come down enough for origination advisory to continue to pick up.
Yes, absolutely, because what can be positive for one part of the business, so trading and markets, might be negative for another part of the business, which is M&A. Yeah. And when we spoke to Venkat earlier on, he was suggesting that we were seeing that pivot a little bit. He was suggesting that we would see a pick-up in investment banking activity, M&A, for example, and other things, as we just get more accustomed, I suppose, to the types of headlines that we're going to see under this current US administration. Do you share that sense that maybe things get better for investment banking fees?
I guess it's like the environment is so volatile and there's so many geopolitical headlines. So I think it's certainly probably a period of stability is needed, and visibility for corporates on what comes next to really execute it on their pipeline. I mean, clearly it seems to be building across different products, ECM, M&A. But at the same time, visibility is needed for corporates and market really to execute. I guess it depends when we come back in September. September is usually a very strong month, and to see activity picking up. Clearly, I hope, but at the same time, a certain level of volatility is needed to sustain the market's revenues. And while they're not totally just a function of volatility, because we've seen banks have a financing business and have put capital into their part that should sustain part of the market's business, it does need some volatility.
So it needs some volatility because is it difficult to think that the third quarter will be as volatile as the second, given what we saw around April? I mean, none of us know.
No.
We don't have a crystal ball and we don't know which headlines will be coming our way. But it's interesting that you point out that it isn't only volatility that drives the successes that we've seen in those markets businesses in the second quarter.
Yeah, no, exactly. You can see some capital allocation and you can see some market share gains. So certainly a combination of various factors to support the performance.
What have been the other themes, some of the more domestic themes? I'm always interested when we speak to these different banks, their level of responsiveness or the reaction function that they demonstrate in their earnings to lower interest rates can be quite varied depending on, the French banks have one type of response. In the UK, we talk about some hedging that means that there isn't quite the response that you'd expect from lower interest rates. I mean, typically, a period where rates are coming down, you would think might not be great for banks, but they've done well.
Yeah,
that.
I mean, you're right. I mean, it's like the bank stocks. I mean, the sector has done so well. So what we need to see with results now is really some earnings upgrades to live up to those valuations. And you can see stocks that didn't meet or beat expectations, they have performed relatively poorly. So it's all about the expectation of economic growth picking up, of yield curve steepening, and also, I guess, the regulation, as mentioned before in the previous comment, is a large driver. So we do need, if we look at net interest income, it's really quite diverse. We have some countries see mortgage growth because rates have coming down. But I guess the one area we're looking for is the corporates to pick up activity, because that's going to be stimulating, and that's what's driven the share prices as well, economic activity picking up. And that's what we really need to see. I mean, it's small signs, but really need to see more of this economic activity picking up into the second half.
And I know we're looking at UBS reporting this week, tomorrow, in fact. What are we going to be watching out for then, Anke?
Yes, so I guess this is the first time UBS is talking in a wider forum after the too big to fail proposal. I expect they won't avoid to comment on it because certainly there will be questions. But at the same time, I don't think UBS will put all cards on the table because clearly that wouldn't probably be supportive for his position. But I think given in the meantime, it's all about capital generation. So earnings do matter because I guess the best defense for any regulation coming their way is capital generation and earnings. So I think that's going to be quite supportive. I mean, if we look at peers, they should report a good set of results given they're quite geared to volatility. But you never quite know. There might be something I didn't quite expect. But
yes. And I know you don't cover Italian banks. I'm not going to ask you specifically about Italian banks, but it does put the M&A theme in my head. Is that something that more widely across Europe we're watching out for? Or do you just think the barriers to that, certainly cross-border or even domestically sometimes, just so many challenges to getting those kind of deals done?
Yeah, I guess the execution risk of those deals has come down because the banks have cleaned up to some extent. Acquisition currencies have been stronger, but it just seems to be political as well as companies don't want to be acquired. So there seem to be so many hurdles as one might have expected.
OK. Anke, thank you very much. Thanks for joining us. Anke Reingen, co-head of Global Financials Research at RBC Capital Markets. That is it for The Pulse. European equity markets then up by around 0.6% today. We're seeing a bit of a bounce back across European stocks after yesterday's selling. What does that mean for the US futures picture? It's flat to positive. Nasdaq futures up by 0.4%. E-minis up by 0.2%. So perhaps a positive day in store. The euro continues to be on the back foot, but is off earlier lows, down by 0.2%, 115.68. Up next, Bloomberg Brief. This is Bloomberg.